What if some of the biggest, most dominant companies out there, the S&P 500 leaders like Apple, Microsoft, Nvidia,
Yeah.
what if they're actually considered like terrible investments when you look at them through a really conservative, old school value lens?
Mhm.
Today, we're doing a deep dive into an analysis that takes some seriously rigorous metrics, these old school value metrics, and applies them to these giants.
Right.
And what it shows is this fascinating, almost shocking disconnect between their current market values and what a traditional value investor would even think about touching.
Welcome, everyone. Yeah, this deep dive is really all about clashing perspectives, different paradigms. We're going to explore some core value investing ideas, specifically the 10 cap rate, margin of safety, and payback time.
Yeah.
And then we'll see how the world's biggest companies stack up against these, well, exceptionally tough criteria.
Yeah.
And what's really interesting isn't just the final numbers, though they are stark, but what it tells us about how different investors actually see value today.
Exactly. Our mission here is to give you a really clear understanding of these valuation tools, these powerful tools, and then show you this stark, data-driven picture of how these companies look through that very old school lens.
Yeah, prepare for maybe a few aha moments.
Definitely. The results might just surprise you, maybe challenge how you think about some big names in your own portfolio. Okay, so let's unpack this Value Investors Toolkit. We should start with this thing called the 10 cap rule. Simple idea, sounds simple, but it's actually incredibly powerful.
Right. And its roots are actually in real estate, aren't they?
They are, yeah.
Yeah.
Imagine you're buying, I don't know, a farm. Let's say it costs $500,000
Okay.
and it generates $50,000 a year in net operating income, NOI. That's your income after operating expenses, but before debt payments and taxes.
Got it.
Your cap rate is simply that $50,000 divided by the $500,000 purchase price. So 10%, it's your unlevered pre-tax return if you paid all cash. It tells you your immediate cash yield on that investment.
And that's the key insight, isn't it? It forces you to view a stock, a business, like you'd view that farm. What's the immediate cash-on-cash return? Forget market hype for a second.
Right.
It's stripping away sentiment and asking, what is this thing actually earning for me right now, today?
Precisely. So value investors, figures like Warren Buffett, they adapted this very tangible idea for stocks. Instead of net operating income, they use something called owner earnings.
Okay.
And they divide that by the company's total market value, its market capitalization. That's just the share price times all the shares out there.
Right.
And the rule of thumb, generally, is that a company looks interesting, maybe undervalued, if this calculation gives you a cap rate of 10% or more.
10%. Okay.
But let's dig into owner earnings. Can you break down why that specific term, that specific calculation is so important for getting this sort of conservative view?
Yeah, absolutely. So owner earnings in its, let's say, purest conceptual form is operating cash flow. That's the cash the business generates just from its normal day-to-day operations, minus maintenance capital expenditures. And that distinction is really critical.
Maintenance CapEx.
Maintenance CapEx is the money a company absolutely has to spend just to keep the lights on, to replace worn-out equipment, repair things, maintain the current level of operations.
Right, just stay in business at the same level.
Exactly. It doesn't include money spent on growth, like building a whole new factory or launching into a new country.
Got it.
So by focusing only on that maintenance CapEx, you're trying to isolate the true earning power of the assets the company already has. It gives you a cleaner picture of operational profitability before you factor in any big expansion plans or how the company finances itself.
That makes a lot of sense. It's like asking, what cash does this thing throw off just by existing as it is right now?
Precisely.
But I noticed something interesting in the report we're looking at today. They actually went even further with the conservatism. They didn't use maintenance CapEx. They calculated owner earnings as operating cash flow minus total capital expenditures.
Ah, yes. That's a key point for this specific analysis.
Yeah, it seems like a big difference. What does using total CapEx do? What does that imply?
Well, it's a fantastic point, and it's really central to how this whole analysis plays out. Using total CapEx means you're essentially penalizing the company for all its capital spending, including the money it's investing for future growth.
Ah, okay.
It's almost like the analyst is saying, look, I only care about the cash left over after absolutely everything is spent. even if that spending is building the next big thing that could double profits down the road.
Wow.
It deliberately makes the hurdle much, much higher. It's designed to find only those businesses that are gushing cash, even while they're potentially investing heavily. It's an extra layer of skepticism baked right in.
Okay, so that's setting an incredibly high bar from the get-go, which brings us neatly to the next piece, the margin of safety.
The cornerstone.
Yeah, the absolute bedrock of preserving capital, famously championed by Benjamin Graham and David Dodd. The idea is simple, but profound. Only buy something when its market price is significantly below what you calculate its real intrinsic value to be.
Right. Intrinsic value being what it's really worth, not just the ticker price.
Exactly. And Buffett had that great analogy, right, about building a bridge. You insist it can hold 30,000 pounds, but you only plan to drive 10,000-pound trucks across it.
Love that analogy. It's perfect.
That extra capacity, that's your margin of safety. And it does three key things. Protects you if your valuation is a bit off, or if something bad and unexpected happens.
Mitigates risk.
Preserves your capital, obviously. And it actually enhances your potential return if things go right. Now, most value folks might look for, say, a 20% or 30% margin.
Pretty standard range.
But this report, it went to the extreme end. It demanded a 50% margin of safety.
50%.
Yeah. For companies like Apple or Microsoft. What does demanding that kind of discount on these giants even signify?
Yeah.
Is it just extreme caution? Or does it imply something deeper about market perception?
It suggests, I think, a really profound skepticism. Applying a 50% OS to the world's biggest, seemingly most stable companies, it signals an investor who wants absolute protection above literally everything else. It implies a belief that either the market prices are, frankly, wildly optimistic, detached from reality,
Right.
or that these giants, despite appearances, carry some kind of hidden systemic risk that justifies needing that massive cushion. It's not just guarding against a calculation error, it's insulating yourself from potential catastrophe.
It's like saying, I'll only buy if it's half price, even after I've already been conservative in figuring out the price.
Pretty much. It's definitely leaning towards the punitive side of value investing.
It really is. Okay, our final metric for today is payback time. Simple, sounds intuitive. How long till I get my money back?
Straightforward question.
Yeah, it just measures how long it takes for the cumulative cash flows from an investment to equal what you initially paid. You divide the initial cost by the annual cash flow, shorter payback, less perceived risk, quicker return of your capital.
Makes sense on the surface.
And it's important to see the direct link to cap rate here. They're basically reciprocals. So the 8-year payback time that this report demands.
8 years.
That implicitly requires a 12.5% cap rate. Remember, the standard was 10%. This is even higher.
So even more demanding than the 10 cap rule.
Exactly. But payback time has some serious flaws, doesn't it? Particularly for the kinds of companies we're looking at.
Oh, absolutely. Two huge ones. First, it completely ignores the time value of money. $1 earned in year 8 is treated the same as $1 earned today.
Which we know isn't right.
Definitely not. And second, and this is critical for growth companies, it totally ignores any cash flows after the payback period. Once you get your initial investment back, this metric says, job done, effectively valuing all future profits at zero.
Wow. Zero value after year 8 in this case.
Yeah. And think about companies like the S&P 500 leaders. Their value isn't just in the next few years, it's in the potential for decades of compounding growth.
Right, the long tail.
Exactly. Payback time prioritizes getting your money-back return of capital over maximizing your long-term return on capital. For a deep value investor, maybe that quick return feels safe. But for anyone focused on long-term compounding, this metric just completely misses the point. It's a blunt instrument.
Okay, so that's our toolkit. Owner earnings calculated very conservatively, a massive 50% margin of safety, and a demanding 8-year payback or 12.5% cap rate.
A very tough set of hurdles.
Definitely. Now let's see what happened when this analysis applied that toolkit to the 10 largest S&P 500 companies over the last decade, roughly fiscal 2015 to 2024. They used public annual reports and, remember, calculated owner earnings as operating cash flow minus total capex.
Right, that uniform, very conservative calculation. It gives us a consistent, if tough, basis for comparing them all.
Let's highlight a few that really tell the story. Take Nvidia, huge story stock, obviously.
Massive, especially recently.
From 2015 to 2020, solid growth. Then 2021 to 2024, with the AI boom, owner earnings just exploded upwards.
Phenomenal operational growth.
But, and here's the kicker, its market cap grew even faster, the stock price went vertical.
Right. The market got way ahead of even those exploding earnings.
So its cap rate, which was, okay, maybe 2.5% to 6.7% earlier, got crushed down to just 1% to 2.1%.
Tiny yield.
Which means the payback time stretched from maybe 15 years, which is already longish, to a staggering 46 to 100 years.
A century. Wow.
Yeah. It just highlights how much future growth is being priced in now. Investors are paying a massive premium today based on the hope of enormous earnings way, way down the line. It's pure growth narrative pricing.
Nvidia is the perfect example of that clash. The market sees decades of AI dominance. This framework sees a 1% immediate cash yield and says, no thanks.
Exactly. Okay, then look at Apple. Just a monster cash machine.
Absolutely. Prodigious amounts of cash.
And interestingly, back in 2015, for a short period, actually did look like a classic value play by some metrics. Its cap rate was almost 12%. Payback around 8 years.
It actually qualified, briefly.
It did. But then as its ecosystem, its services business, really took hold and showed incredible resilience, the market dramatically re-rated the stock. The valuation multiple expanded hugely.
Right. It shifted.
It shifted from being maybe value to being quality at a premium price. Now its cap rates are down in the 3–5% range, payback over 30 years.
So Apple shows how a company's success can actually price it out of the deep value category. The market recognizes the quality and stability and says, we'll pay up for that certainty, even if the immediate yield is lower.
Great point. And one more, maybe as a contrast, Berkshire Hathaway, Warren Buffett's company.
The quintessential value-oriented conglomerate.
Yeah, and it really stands out for its stability, consistent cash generation. Owner earnings nearly doubled over the decade. But what's fascinating is his valuation stayed relatively rational, consistent compared to the others.
Grounded.
Yeah, cap rate stayed in a pretty narrow band, like 3.5% to 5.2%. Payback lengthened, sure, for maybe 20 to 28 years, but gradually. It reflects that steady appreciation, its status as a safe haven.
But even Berkshire.
Right. Even Berkshire, the model of value creation, still end up looking expensive through this ultra-conservative lens we're using today.
It really underscores just how demanding these specific criteria are. If even Berkshire doesn't clear the bar by a huge margin, it tells you something about the filter itself.
Definitely.
Yeah.
And the stories for the others, Microsoft, Amazon, Meta, Broadcom, Tesla, they mostly echo these themes. You see compressed cap rates because market excitement outpaced even strong earnings growth.
Right.
You see high volatility in owner earnings, especially for companies investing heavily, like Amazon or Tesla, making the metric bounce around.
Or even turn negative.
Exactly. Or you run into issues where this cash flow framework just isn't the best fit, like with a big bank like JP Chase.
Yeah.
Their operating cash flow is notoriously volatile and doesn't mean the same thing.
Yeah. Different business model entirely. Ill-suited for this specific tool.
So for most of them, the market was clearly looking past the immediate, conservatively calculated cash flow. It was valuing revenue growth, future potential like AWS for Amazon, AI for Microsoft and Broadcom, EV dominance for Tesla, network effects for Meta. Things this framework doesn't really capture.
Intangibles and long-term narratives.
Precisely. Okay, so we've got the tools. We've seen how the companies performed historically against them. Now for the really interesting part, calculating an actual buy price using this ultra-conservative framework.
The moment of truth based on these rules.
Right. First step, establishing a conservative growth rate. Yay. The report did something pretty brutal here. It took the single lowest annual growth rate in owner earnings each company experienced over the entire past decade.
The worst year's growth. Ouch.
Yeah. So if a company had one bad year where owner earnings dipped, that negative growth rate, or very low growth rate, was assumed to be the permanent future growth rate for valuation purposes.
Wow, okay. That's not just conservative, that's almost assuming the worst historical blip becomes the new normal forever. Stress testing it against a worst-case scenario becoming permanent.
Exactly. Then they plug this ultra-conservative growth rate into a standard perpetual growth model to get an intrinsic value. The formula is basically intrinsic value equals owner earnings next year. Discount rate, growth rate.
Standard model, but with punishing inputs.
Right. They used a 10% discount rate. That's the minimum return the investor demands. And remember, G is that potentially negative or tiny growth rate.
Okay. So you get a very low intrinsic value estimate to start with.
You do. But then they applied the final two constraints, layering them on top. First, that massive 50% margin of safety. So they took that already conservatively calculated intrinsic value and just cut it in half.
Cut it in half. Okay.
And second, they calculated the price needed to achieve that 8-year payback, which we know equals a 12.5% cap rate demand.
Got it. So 2 potential buy prices calculated.
Exactly. And the lower of those two became the final target buy price. And of course, if owner earnings were negative, or if that worst-case growth rate, G, was actually higher than the 10% discount rate, which happens sometimes with volatile earnings, the model just broke. It was mathematically invalid.
Deeming them instantly uninvestable under these rules.
Right. So when you apply this incredibly tough, backward-looking growth assumption, plus the 50% MOS, plus the 12.5% required yield, what kind of results do you think you get for these market darlings?
I'm guessing not pretty. That sounds like a framework designed to say no to almost everything in the current market, a real gauntlet.
You guessed right. The findings were, stark is putting it mildly.
Right.
The report's conclusion was that none of these top 10 S&P 500 leaders currently represent an investable opportunity based on these specific conservative criteria.
None of them. Wow.
The calculated buy prices were just tiny fractions of where the stocks were actually trading.
Yeah.
The required downsides were massive, ranging from 80% to over 96%.
96% downside. Good grief.
Yeah. And for several of them, Amazon, Meta, Broadcom, Tesla, JP Morgan, the model, was, as we anticipated, mathematically invalid because of negative owner earnings in some years, or weird growth rates derived from that worst year rule.
So they didn't even get a price target, just a fail.
Pretty much. Let me throw out a few numbers just to illustrate how dramatic this is. Nvidia, trading around $125 at the time of the analysis, the target buy price was $25. That's an 80% drop needed.
Okay.
Apple, trading around $250, target buy price $8.18. A 96.2% downside required.
Yes, criminal.
$8.
Microsoft.
Around $450, target price $27.34. That's a 93.9% downside.
Almost 94%.
And even Berkshire Hathaway, maybe the closest thing to a traditional value stock in the list, trading around $620,000 for the A shares, the target price is $61,914, still needing roughly a 90% drop.
So even the Oracle of Omaha's own company doesn't pass his own, well, maybe not his rules, but these extremely stringent rules.
Exactly. So what does this all mean? What's the big picture takeaway from this exercise?
Well, it fundamentally highlights this profound disconnect, doesn't it, between how the current market is valuing these absolute titans and how a deep value investor, rigidly sticking to these specific metrics, would see them. It's a fundamental clash of investment philosophies, of paradigms.
Yeah, absolutely. On one side, you got the market narrative. It's all about sustained high growth, tech dominance, network effects, AI revolutions, long-term compounding.
The future potential.
Right. It's a quality at a premium, or maybe even growth at any price mindset sometimes. Investors are clearly willing to pay a very significant premium today for the promise of much, much larger cash flows way out in the future.
They're discounting the distant future at a lower rate, essentially, believing in that long-term story.
Exactly. And on the other side, you have the framework used in this report. It represents the polar opposite end of the spectrum.
Totally different philosophy.
It's deep value, statistical, almost mechanical. It prioritizes just 3 things above all else. First, a high immediate cash-on-cash return, that 12.5% cap rate.
Cash now. Second, protection against the absolute worst-case historical performance becoming permanent using that lowest growth rate.
Protect the downside, assume the worst.
And third, an enormous margin for error, that 50% margin of safety. It's about wanting absolute safety and clearly demonstrable value today.
Less about forecasting the future, more about assessing the present reality very, very harshly.
Precisely. This framework is basically built, it's structurally designed to ignore or heavily discount long-term growth stories and intangible assets. Brand, moat, innovation pipelines.
All the things the market seems to love right now.
Right. It disregards those in favor of hard, tangible, immediate cash yield and statistical safety nets. And the analysis just lays it bare. If you are an investor who rigidly follows these specific, very severe constraints, then the most popular, most successful, most widely owned companies in the world today, they're likely going to look perpetually uninvestable. The gauntlet was thrown down, and by its incredibly strict rules, none of these titans came close to passing.
A sobering perspective, depending on how you look at it. It really is. And just to be clear, this deep talk wasn't about saying Nvidia or Apple will crash 90%. It wasn't predicting their future.
No, not at all.
It was about understanding different ways to define and measure value, and seeing how today's market leaders stack up against one Very specific, very conservative methodology.
And it really forces you to think, doesn't it? Is the current market sentiment justified? Is this time different? Is there a new paradigm of growth and innovation that makes these old rules less relevant for these specific companies?
Yeah.
Or is the market maybe overlooking fundamental safety principles in its enthusiasm? What happens if those growth narratives falter? What's the underlying value then?
Those are the big questions. So what stands out to you listening to this? Does this analysis resonate? Does it clash with how you see things? What does it tell you about your own investment philosophy, maybe?
Lots to chew on there.
Definitely. We hope this deep dive has given you some fresh perspective. And hey, if you are interested in tracking overall market valuation, sort of the bigger picture, you might want to check out an app called the Buffett Indicator. You can search for it and download it from the iOS App Store. It gives you daily updates on that specific metric.
And of course, if you find these kinds of deep dives into value investing topics interesting, please do subscribe to our channel, Deep Value Investing, on Apple Podcasts or Spotify.
Yeah, and check the description for this deep dive. We've put a list of some foundational value investing books there too.
Great resources.
And finally, the standard disclaimer. All the analysis we discuss is based on publicly available information. It's for educational purposes only.
Definitely not investment advice.
Nope. Please always do your own research and due diligence before making any investment decisions.